Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jerad and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry.
Welcome back, everybody, to a special reinsurance news episode looking back over the month of November. How are you doing, Jerad?
Yeah, good. It's the cold is coming in now, end of the year wrapping up, which means renewal season is upon us. So we're going to dive right
Absolutely.
in.
Exciting
Tons
time
of
to be
stuff.
alive.
Yeah, tons and tons of stuff coming up as we go into this renewal season. One that we've sort of been talking about and forecasting now for the better part of a couple months, coming out of Monte Carlo and Baden-Baden and everything. So getting to the finish line now for people. So long nights in the office, but there's nothing to do because it's always dark. So in we go to the news.
I did
There's
enjoy
a
seeing
Go ahead.
did you see the Supercede renewals bingo?
Yes, if you haven't seen that, follow us on LinkedIn. You will see renewals bingo, which is which is out by us. Hopefully not causing too much PTSD for people spending late nights in the office, but we will see. But the whole topic of conversation going into this renewals was all around what was pricing going to do off the back of the last couple of years, what might the impact of hurricane seasons and social inflation and all of these things do to this renewal season. And you're getting a bunch of different sort of commentary in the market. So we'll sort of start to pick that apart on this episode. The first piece of news here coming from Munich Re talking about the expectation that property cat pricing will plateau in this 1/1. Right. So that feels like a good position for the cedents, especially.
Yeah, we're getting a commentary that we may be peaking, which I think was interesting in terms of rate rises there. But then it's a slightly nuanced conversation, isn't it? Because if you look at Central Europe, for example, probably going to see 15 to 20% up there, according to SCOR. We've seen others say that the pricing environment's going to come down. I think Morgan Stanley gave some commentary this month on how we might see the overall pricing head downwards. And then, of course, if you look at casualty, quite a different story there, or all things affected by social inflation, I guess, Jared.
Yeah, well, that's the news coming out of Swiss Re is that there's like a need for increases in all the social inflation exposed lines, right? And as you say, this is, as it oftentimes is, very much class and region dependent, right? If you talk about prop cat in the aggregate, it's very heavily weighted towards North America, which might be nearing the peak, but that might not be the case in Europe, as you pointed out. So the same thing happening here with casualty. You're seeing a need, at least one being expressed by Swiss Re, for prices needing to come up there to offset some of those social inflation growth costs that are rising.
Yeah, for sure. I think one of the really interesting things is it seems that we are reaching this plateau, as you say, or what's being described as a stable renewals, but still a very attractive renewals. And I think some of that might be coming from the fact that the Helene and Milton losses are looking quite similar to the Hurricane Ian experience. I think JP Morgan had put something out on the similarity of those events. Obviously, after the Ian losses, we had quite a severe reset of the market towards terms that people could accept that within. And the fact that it hasn't jumped again and that we're seeing this as fairly stable post Helene and post Milton suggests that stability really is the right way to look at this market. If it's still attractive, it's still stable post, another Ian, then maybe we've built a market that's able to sustain itself with fairly frequent Ian type events.
Yeah, well, and that's where we want to get to. What we've been talking about for the last couple of renewal seasons is can we get to that balanced position where it's not surging between peaks of the hard market or depths of the soft market. It's a stable market that has that behavior to it. And I think you're exactly right on that. And it's this awareness. S&P's come out here with this awareness of, you know, could these cat events and could the ability for the market to withstand those impact issuer and instrument credit, right? This relationship between how the various instruments by which we protect risk balance and find a position in a larger environment that has these sort of continued large events that happen, but a market's positioning and pricing that seems to be balancing it out in giving it a nice landing place.
Yeah, and I was actually quite drawn to, in a similar vein, a piece by Peter Zaffino, so the AIG CEO, a bit earlier in the month, just commenting really that the reinsurers as a market aren't going to be able to solve the frequency and severity losses in 2025 just because of the sheer scale of these. And so that is going to keep on pushing sort of the brunt of some of these industry losses onto the primary insurers and perhaps ultimately their policyholders as well, because there is this bit in the middle, or even this bit that might shift from the middle to the original risk holders. Even if the reinsurance market continues to serve its believed purpose as, there for the last resort for the really serious events. So if the reinsurers are taking that part, the insurers, are taking then the middle bit, but possibly having to again, step away a little bit and change their terms and their conditions of what they're willing to offer. It's an interesting time to be a risk manager, I suppose, or indeed a consumer policyholder.
Yeah, and it transitions really nicely into this article I wanted to talk about that's come out of Willis Towers Watson, which sort of references that only 1 in 2 risk leaders are confident in their organization's risk response capabilities, right? And kind of to your point, some of that is a requirement or a need to sort of bring more of that in-house, and other parts of it is there's not always an insurance or reinsurance product clearly aligned with helping them solve for specific needs. But this isn't the first time we've heard this sort of analysis. We've seen this from Aon and stuff for the last few years as well.
Yeah, absolutely. What's interesting is that I guess in this challenging context for finance and insurance at large, we're seeing the new British government coming out to say that they are consulting on introducing a new framework for UK-based captive insurance companies to make the market more attractive as a hub. But that's quite interesting in many ways. You think about captives and the role they normally play. They are available to risk managers in a way that insurance companies might not be. So again, we might see almost an extension of the chain and people more successfully managing the burden of retaining more risk within a specified vehicle before it goes to the insurance markets. So yeah, these conditions are creating new ways of running the market, albeit gradually.
Yeah, no, absolutely. The last topic I wanted to sort of bring up was one that's sort of near and dear to our hearts, but about the insurtech landscape and what that funding environment looks like from Q3. We've got the Gallagher report here now with their insurtech report. If you haven't read this is always a really good piece of work that's put out. But there's been this massive surge in funding in the last quarter. Much of it, as you'd probably expect in the current day and age, being driven by AI-focused insurtechs or companies looking to better leverage that. But there's a shift here, as we've talked about a lot in the past. The weighting of insurtech investment oftentimes being disproportionately impacted by the mega rounds, right? The several £100 million rounds or more from sort of companies about to go public or in like Series C and Series D rounds, and that's also the case here. So. A surge in funding with £897 million raised, but a decrease in overall deal size. 77 deals were done in the quarter, which is the lowest in nearly 4 years. So the return of the mega rounds, which again, I think you put it really nicely in sort of our chat before this, but an awareness that there's sort of this firming up of the people who are going to be dominant players, but an aversion still towards, Series A and earlier companies that haven't quite proven themselves out yet.
Yeah, and I think there's been a experimentation phase for probably even it's probably finished before we've got around to reporting it in some ways. It takes time for these things to actually become talked about and recognized. A few publications before us have said InsurTech is dead, etc. But there was probably a prior period of about 6 or 7 years that was just experimenting and trying to figure out what would actually be useful. And I feel like now we're in a maturation stage where there are a few players who've figured out how to actually do valuable things for insurers, for capital, for risk holders, in such a way that they are becoming more investable. And so if you're sat guarding a pot of VC money, it's more attractive actually to pump it into vehicles creating value rather than experimenting, especially with interest rates still being where they are.
Yeah. Well, we've seen this in other categories, right? And the simple consumer stuff in the earliest days of mobile, like the VCs were chucking money at everyone making an app on your phone. But then it very quickly became aware of like how you define which companies are going to create value, which ones are going to win consumers. That same exact experimentation and now maturation is happening in insurtech, right? It's at first everything was like the whole market's going to change and look so different, and it's everyone backing everything, and now it's a much more sophisticated view of what types of companies win in the insurtech landscape, and I think the investors are being far more thoughtful around where they place their bets. But that's the news for November. We've got one more update before the renewal season is over, so watch for the December updates here. But any parting shots of wisdom as people go into their long nights at the office, Ben?
Only to wish everybody good luck, and I bet you wish you had Supercede if you don't already. Enjoy.
Thanks, everybody.
See you soon.
Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts. You'll find the links in the show notes.